welcome to the Real Estate Reserve Podcast. I'm Jason Balin from Hard Money Bankers. This is Ian Horowitz, co-host of the podcast. Welcome. If this is your first time tuning in, welcome. I promise we will keep this very entertaining for you. We always bring on some great guests that are doing local and good deals. So that's always a good plus. If you're a return viewer, follower, listener, watcher, thanks again for all your support. We couldn't, can't thank you guys enough for continuing to tune in week after week. This is year 4, going on 5 of the podcast. And as promised, we've continued to bring on great guests. In a second, we're going to bring on Jon Weiskopf from Blue Eye Capital. He's a commercial real estate investor, with expertise in a bunch of different asset classes. So looking forward to the conversation here with Jon in a second.
Yeah, definitely excited for that. Guys, if you get any value out of today's episode, we don't care about the likes, the shares, the subscribes, none of that. What we do care about, we do care about the shares. We don't care about the likes and the subscribes. It's the best compliment we can give our guests. These are just normal people coming on here talking about the deals that they're doing. And the best thing we can do is share the episode and get them some feedback. Anyone that's following along over at CRE-syndicate.com, I am still deep in the middle of this $50 million challenge. It's going to come down to the wire here. The end of the year is going to approach really, really fast. At the time of this recording, we're in the process of closing a deal. It's a little bit of a shit show. We'll do a case study on that here shortly. But enough about us, and let's bring in Jon. What's up, brother?
Jon, how are you?
Fellas?
Yeah, so we learned about a new place in Wisconsin today as we brought on Jon. He's way up there in Wisconsin. You just want to quick tell us about what you do, and we'll hop into your story here in a second.
Yeah, sure. Let's see. Owner of Blue Eye Capital was started about 2 years ago. Come from about 20 years of commercial real estate, but my expertise is really in building design and operations. Doing it, and it's kind of what got me into this mess of a world of real estate, I guess you can call it. It's crazy now these days. So yeah, excited to be here.
When did you take the leap into real estate, and what attracted you to commercial real estate? I mean, you when we were talking earlier, we kind of were just talking about commercial stuff. I don't know, maybe you were in residential real estate first, but has it always been commercial real estate?
Always commercial, man. 20 years ago, a little over 20 years, I graduated college, mechanical engineer, wanted to do race car engineering, big into Formula One. That was not in the books, or I don't know, maybe I didn't find the right people. And got my first job designing air conditioning systems. And from there, my career just moved. And so, it was 2 years ago when I kind of got knocked on the side of the head and realized, what am I doing this stuff for everybody else? Why am I not doing this for myself? And so that's really where everything started. And, I find myself today.
Yeah. If I could just make a quick connection here, sorry, Jay, but your commercial real estate background designing HVAC, I believe it is, that was with a major corporation. What did that look like with them? And I guess, how do they, and I'm sure you're comfortable saying who the employer was. I don't want to put you out there until you are, but I guess they had their own internal engineering teams as they're building out stores. I always thought it was a lot of third-party stuff that they utilized to build retail shops.
Yeah, man. Good question. So started as a consultant, and then about 10 years ago, I moved out to California and started working for Apple. I was the first engineer that their retail real estate group hired, and I built the program for them. Built that up over 10 years. And yeah, most of the stuff they did was in-house. We hired consultants, Ian, as you mentioned, but Apple was about controlling their destiny. And so it's a lot about being intelligent about who it is that you're hiring, how it is that you're doing it. And so, I found myself flying all over the world, building cool stuff, but mostly commercial, right? So high-rise residential, in previous life, and then retail real estate for 10 strong years, but it got old and boring and stressful.
Yeah, no, that makes sense. It's interesting because I don't think people realize how many big corporations have like commercial real estate divisions. I know Jason, he's just outside of DC. A lot of his friends have businesses that service these big corporations in and around DC. That there's actually commercial real estate more than, and I know we talk a lot about investing because that's what the ultimate goal is, but it is interesting to see that a lot of corporations have their own divisions, their own execution of that commercial real estate piece.
Big portion. Yeah. Oh yeah.
Yeah, no doubt. And I also think that, a lot of real estate investors, the barrier to entry, sometimes they get nervous because it's like, well, I can't compete with Apple. How am I going to, buy a building or lease a building or anything else? It's like, you don't need to. There's plenty of buildings to go around. There's plenty of money to go around. And guess what? They're not going to be your competition, especially at the beginning, because they're going to be looking for much bigger, returns and much bigger stuff than you are. What did your first deal look like that you did? Like you took the plunge. You're like, you know what? I want to start owning real estate. I want to start buying real estate. Tell us a little bit about the first deal that you ever did.
Sure. It took, let's see, from kind of starting to getting into it, took me about 6 months, and it was a syndication. It was a 2-portfolio deal. So 64 unit Section 8 low income housing tax credit property in Louisville, Kentucky, and then a 92 unit Class C that is meant to balance out the portfolio in Lubbock, Texas. Still owned today. It's not been the easiest thing of my life. Probably one of the hardest.
Sure.
I would say the hardest part is actually transitioning from corporate life to partnerships where everybody has a little bit of a different definition or expectation of what success looks like, what good looks like, what commitment looks like. When you work for a company, especially somebody like Apple, everybody's all in. You have to be every single day. You have to be at your top at all the time. And not the world I find myself in my first syndication. So learning experience, I guess.
Yeah, let's go down that road a little bit. I think that's really beneficial to hear for a lot of people to hear, real life, what's going on. So in this particular deal, I'm assuming you're the GP on this deal. You're operating this, and this is like your baby that you found, and you signed on debt, I'm guessing. And
I did not sign on debt. So there is one main sponsor, and then there are 5 total GPs, myself being one of them. I help assist the asset management team, and I help raise capital.
And you help raise capital on that. And is this which facility was it? There's the Class C one we're talking about? Or
there's 2. Yeah. So it was actually a 2-portfolio deal as part of the syndication, right? So we bought 2 properties as under one syndication.
Got it. So there's at least 5 chefs in the kitchen, which is probably one thing that is challenging. And I think this is good to kind of to discuss in general, because I think a lot of people don't realize it's like, I'm just going to buy a property, or I'm just going to go partner with these people, or do this or do that. And that's not always the answer. Like, what are some of the challenges that have kind of, come up? Is there issues with the building? Was it hard to raise capital, or is it just kind of butting heads with different people have different opinions on what you should do?
Shit, man. All of the above.
Remember, guys, this is the real show, real people doing real deals. Here you go. This is the real shit right here.
So we were short rate. We shorted the raise. We were short about $100,000. So as GPs, we took a hit on the acquisition fee to cover the lack of raise. It is what it is. You have to, right? The money was still needed. I was brought in by the sponsor, and the sponsor and I are friends today, still friends. And that is the person that I did my due diligence on. That is where I made my first mistake in looking back. The asset management team is less experienced than I was made to understand or believe. Again, coming from a corporate world, detail, things in order, processes, all those things set that you drive a big, gigantic business machine to. I guess I was kind of jaded and expecting all that stuff to be prepared. Business plans to be fully worked out every year, right? We started this year with no second year business plan. Honestly, we still don't have one. We spent all of our CapEx. Some we probably should have been more controlled about. Some we underestimated how much damage evicting tenants were going to cause on their way out. And so, just because you spend the money doesn't mean that the problems that you didn't spend the money on have gone away, right? We have tons of air conditioning units that are old that need to be replaced, and we're out of money to do it. And so, the challenge today is everybody's got different opinions. There's a lot of infighting within GPs. I try to stay neutral, man. I'm a neutral guy. I try to work from facts and numbers and do things like that. But it's a mix of all of it. We are today trying to figure out if it's right to continue as a partnership or to exit and save our investors' capital and kind of just go on.
Yeah, and that's the premier thing, right? Protecting your investors, protecting that capital. The last thing you can do as a sponsor is let that get wiped. It's interesting. Everybody has challenges. We have challenges. We've syndicated a bunch of deals. We have fires that burn. The question is, and I'm interested to hear your opinion on this, right? Because you come from the corporate world, corporate resolution. A lot of the time is let's throw money at it until the problem goes away. I was a fireman full time for the city of Baltimore for 15 years, along with my business partner. We didn't have a lot of money, so our way to solve problems is get our hands really, really stinking dirty until we get it resolved and keep going at it. How has your corporate world experience, would you say, in resolving these problems? What do you lean more towards? Is it like, okay, well, if I had enough money, I can overcome the problem, or I just need partners that had enough grit to overcome that problem? Or is it a combination of both?
Honestly, man, I think it's a combination of both. Apple had tons of money, but don't be fooled that they spent their money frivolously or at a whim, right? They expected results. I think the biggest difference that I've come to realize or had to figure out is not all companies spend money with a need for return on investment. Sometimes you spend money because the business says this is what we stand for. This is what we should be doing. So we have to do it, right? It maybe sucks, but you do it. Syndications and other things, when you're taking other people's money, everybody expects every single dollar to produce more than the dollar that you put into it. And if you can't, why? Right? And so that's something that's been, I guess, I knew, but until you face it, until you're right into it, it doesn't really register, right? It doesn't really come out. I think grit is necessary in any business that you do, right? Apple expect you to work your butt off. No was never an answer. And I think that's the difference that I'm seeing today is, I got some partners maybe throwing up their hands a little bit, or we're not making money. So, I got an email the other day from my asset manager that said, I've cut back my time. Well, you didn't tell the rest of the GPs, and, maybe the cutting back the time is why we're not producing today.
Yeah.
So,
well,
I think there's personal financial situations in partnerships and other things that should not come into the mix, but they do, and they have.
Well, that's so Jason has invested transparently. It's been spoken on the show before into a lot of our deals, and a lot of the conversation revolves of, well, how do we get monetized? How do they get monetized? Right? Because the last thing you want is an operator. And if I'm the operator of the real estate, to not be able to make money or have a path to making money, fuck it, I'm out. Right. And I toss my hands up, and now Jason's screwed. But we're friends, right? So we've had a lot of conversations, and there's been deals where it was like, you know what? I'd rather give Jason a little more pref. We get to make a little more money. I'm giving up some front side in exchange for a larger upside on the back. He knows I'm motivated by that. Or there's been other scenarios where we've taken less up front, less on the back in exchange for a lower preferred return, but more equity to Jason because maybe they needed the depreciation or something along those lines. It's conversations Jason and I have a lot on those types of things.
Yeah. Well, and also, I mean, listen, how in general, how long did it take you to underwrite the deal on the front end, right? And then how long did it take you to underwrite your capital investors? Because just because somebody wants to invest in a deal doesn't necessarily mean, and I mean, I've learned this because raised capital for the last 17 years for our lending company. Just because somebody wants to put money with us doesn't mean I'm going to accept it, right? Like, you take capital from the wrong person, you are screwed. Like, it's bad. It's got to be the right investor.
I haven't experienced that yet. I mean, I think our investors are not happy. I mean, let's be honest, right? They're not. We haven't made a distribution this year.
Yeah.
Right. And we were short last year. And it's unfortunate now because part of our squabbling is, and I say this with all transparency, and I have fault in this too. I have ownership in this too, right? It's not one person on the team that has caused a single problem and is the cause of everything. But, we keep telling our investors and giving them updates, but it's painful and it's hard. And when you can't give them the answer because sometimes answers aren't readily available, or there isn't an answer right away, you got to figure out a way to at least share information. I mean, look, I have some LP investments that, I've watched the operator less and less information as things got worse and worse and worse. And that's the worst thing, because you have my money and I don't know what you're doing with it. I understand that life is not perfect, but
transparency.
The worst thing you can do is not tell me, right?
Everything needs to be as transparent as possible, especially when you have other people's money at risk. But going back to what I was saying related to underwriting investors and deals, is like, you got to underwrite your partners as well. And that's one that I think a lot of people forget about. It's like, I don't know. I can't tell you how many endless opportunities people will be like, hey, you want to partner on this deal? You want to do this? I'm like, absolutely not. I don't want any, no, I'll be the lender on the deal, but like, I don't want to be like your business partner on this, because that's what it is. It's a marriage. And, when you started this conversation with 5L, with 5 GPs, and it's just like, that's tough. The good part about a lot of this is, and Ian can attest to this. And I mean, he's changed his investment strategy a lot over the last few years, knowing what's worked and what didn't work. And you really don't, I hate to say it, but you really don't know what's going to work and what's not going to work until you've been in it and do it the hard way. And us too. I mean, our average loan that I did years ago when we started was very different than the way it looks today. Right now, when we do a loan, like, I know what's going to happen. I already can see the future of what's going to happen or what's not going to happen in this. A lot of times our borrowers might not see that. And, I've got some business partners that run other offices for us. And sometimes I'm like, listen, just trust me. We're not doing this deal. I know on paper it might seem like it's a good deal, but it's not. This is what's going to happen in 3 months or 4 months. So, the thing with all of this stuff is you just learn, right? And it comes from experience and it comes with headaches. But, like, if everything was super easy, I mean, here's the other side of it. If everything was easy, this is at least my take on this, is maybe not in the commercial world, but in the residential real estate world, a lot of flippers made a lot of money over the last 10 years because the housing, you buy a property and it just doubled in price and then it doubles again. It's like, oh, this is easy. And it doesn't take until something changes and a big slap in their face before they realize it's like, you're actually not all that smart, and you actually have no idea what you're doing, and you actually have no business fundamentals, and you don't have anything else. You just happen to be lucky when the timing comes. And luck's fine, but luck's not a strategy, right? It's just, you're lucky. And if you're able to do that, and I never really, successful operators to me are the ones, residential and commercial, that have built real businesses and real foundations. And maybe they haven't hit a home run because they didn't, get lucky with timing, but like, they have a real business and it'll work in any market, any environment, at any time, and they know what they're doing. So I think sometimes you got to have to go through some of these pains, to accomplish them. And hopefully, hope the market's appreciated, so the values of the properties hopefully have gone up a little bit, and hopefully there's other things that help out. So it's not like, hey, I'm freaking bankrupt because I did one bad deal. That's not obviously the wish on anybody. But again, I think Ian's point was good. It's like, hey, can I throw money at this, or should we just get our hands dirty and figure out a way that we got to clean this damn thing up and move on to something else?
It's hard sometimes because you got to make that decision too.
Yeah.
Yeah, no,
sometimes in corporate America, a lot of your decisions. Oh, sorry. I was going to say, in corporate America, a lot of times your decisions are made for you.
Well, right. That they, but they're sitting in the C-suite, right? They're having those conversations, whatever. They're out, supposedly, whatever. Depends how you want to look at it. But somewhere along the line, someone's having a discussion that says, and this is what we do in our business, and I'm sure it's something similar in corporate America, this piece of our business sucks. Shut it down, right? So every month we sit down, we do the 80-20 rule, and we go through the portfolio, every single property, whether it's single family, commercial, does not matter. Is it working? Is it not? If it's not working, are we going to fix it or are we going to dump it? If we're going to dump it, how are we executing that sale? If we're going to fix it, what's the execution plan? And if it's working good, let's just shut our mouths and we'll deal with it at a later date. So we've started moving single families off the books. We started listing some commercial properties, saying, okay, well, here's our headaches. Let's move off of this and let's execute on what we're good at. And we're good at value add and building shit. That's what we want to continue to execute on. And if the asset management isn't going correctly, then we don't have the right property manager in place, or we can't vertically integrate it within our team. Off it goes and it's gone. So it's been growth, but that's years of growth. Jason tells me all the time, sell everything. The market's going to crash. The end of the world's coming. He's a lender. There's a reason he's a lender and I'm not. I'm like, it's great. There's nothing wrong, but we need investors like that to challenge us. And, you bring up about not communicating. I tell our investors up front, my communication is absolutely the worst. You want to know anything that's going on, you just call me. I'm not great at sending out your emails and all that other stuff, but I'm a part of a volunteer organization and they're having some turmoil right now. And the president doesn't know what to do. And he's in shutdown mode. And then he's closing bank accounts. And we're like, dude, are you stealing money? He's like, no. And the guy's like such a good dude. Like I hope I'm not going on record and saying this wrong, but it's like, there's no way the dude's stealing money. Just, he doesn't know how to communicate. And he's so deep in it, doesn't know what to do. So, I mean, this experience that you've had as an LP and being able to share it is like really, really powerful. But let's turn this into the positive. So you're dealing with this. Obviously you're continuing on and buying stuff. What are we doing today? How have we moved the needle in the correct direction?
Sure. One of the biggest things I think I learned was, when you start in this and videos and learnings and teachings and all that stuff, everybody's this 3 to 5 year hold thing. And, coming from the world of buildings and knowing what it takes to operate them, I let myself be I'm going to say this, fooled or tricked into thinking that the 3 to 5 year game is really the right way to go. And so for me, it's more about long-term outlooks now, long-term planning, long-term holds, 10 years, 7, 10, even longer. I'm big about environmental kind of impact and where the world's headed, big about social impact. And, affordability is a problem for a lot of people. I'm fortunate where it's not for me. But, I started this business to support my family and give something to my son. As he grows up and, has access to a business and things like that. And so as I see affordability getting only worse in America, to me, the asset class of choice is what people can afford. And that is mobile homes. So, I'm moving in that direction at the moment. Multifamily I'm going to be blunt. It just sucks right now. It just really sucks. Not to say that I don't think that there's good investments out there for people. But long-term for me is where am I going to position myself? So 5 years from now, when the world situation or economic situation, affordability situation is worse, that I'm still sitting in an asset class that is able to, stand up the test of time to those problems. So I got a big fund coming out that I'm launching with a partner of mine. And, it's long-term holds, infinite returns. But our approach is really how to use refinance events, not to give capital back, but to reinvest that capital and buy more. So it's accumulation, I guess, is a simple way of putting it.
Yeah, we've had similar mindset of like legacy is how we like to talk about it, is like legacy assets. Everything we've performed on in our single family days was buy it, refinance it, keep proceeds, reinvest it. How can we do that for capital investors in the same fashion? And, Jason and I have done a few deals together where we've had a nice refi pop, but, again, it goes back to the other conversation of, well, now that asset's turning into a problem to manage. And it's like, well, Jay, we already got paid out once. We can get paid out again. You know what? We might sell this. And keep it moving. And it's like, well, yeah, it's a great conversation to have rather than saying, well, we refied and now we lost the property. But once you are refied and returns are infinite, it goes a very long way. Is, you're talking about affordability. Are you going to stay in the Section 8? Or are you going to look at mobile homes, LIHTC deals? Like what would your fund be investing in?
Yeah, so the fund is specific to mobile home parks, and our approach is really about, simply put, buying distressed assets and turning them into institutional grade assets, and that's through either value add, removing old homes, bringing new ones in, or buying a park that maybe is okay but has tons of expansion potential. If you research mobile home manufacturers, there's a huge impact in their production during COVID, and a lot of those businesses are sitting on a lot of stock that they need to get rid of. And so we're finding manufacturers that are willing to sell not only at a discount but also deliver and set them up just to get stuff off their lots. And we're trying to get into this asset before a lot more people start to enter the space. I think it's only the beginning for mobile homes. I'm also very, very interested in modular construction and how prefabbed offsite construction can be a replacement and expedited way of producing units.
Yeah, they definitely provide an interesting way to operate. A buddy of ours, Jimmy, he was a new home builder, and then he went the prefab route to expedite the process. Probably a little different than what you're talking about, but prefab to expedite the process. And I think what people expect of mobile homes today, and I'd like to talk about this a little bit, I think of like Tornado Alley just getting mowed over. Like, let's talk about mobile home parks, because I do know from like where our storage stuff is in the South, a lot like mobile homes are very prevalent and people are like very into them. And I heard a lot of people talking about like the older population can't afford housing stock right now, and instead of going to apartments or assisted livings, they're going to, we call them mobile homes or prefabbed homes. Like, I think there's a misconception there, and I'd like to hear your opinion on it. Like I said, I just think Tornado Alley, yeehaw, let's 8 Mile M&M style.
Look, those exist, so that's not necessarily wrong, but the stigma of that is the prevalent opinion and stigma, and so it keeps people away. Right up here in Wisconsin, where I'm at, there's 1,000 unit mobile home park that's been around since 1970. You drive through it, it's like its own little city, right? And sure, are there some older ones? Yeah, but good portion of the population lives in them and they enjoy them. I mean, you see them being replaced all the time. You see people make this their home. And your point about retirees, 4 million people are retiring a year right now for the next, I think, 3 or 4 years, right? The biggest retirement amount of people ever in America's history. The average individual retiring is making $47,000. That's the retirement income. What can that buy you? Can't buy you much. You're low income with that amount.
Yeah.
Like you're low income, right? And so with apartment rents going up, you see this compression of what can people afford, and a lot of people are downsizing. I don't think it's for everybody, guys. It's not, but you look at the population. There's a lot to go. We said at the beginning, right? There's a lot of stuff to go around.
So is your strategy for these parks is to buy the park, not own any of the
trailers, tenant owned homes,
and then get the lease or pad lease? Because how Ian said, and I think John confirmed, is like mobile home parks look very different in lots of different areas. We underwrote a loan that we were going to do that I didn't realize was a mobile home park at this, or I wouldn't have gotten this far with it. But in essence, it was, if you look on Google, it was an interesting one. If you look on Google Street View, it looked like exactly what Ian stated. It was in Florida, and it was on like a little peninsula on the water, right? So like everyone had a waterfront, not everybody, but like a lot of them had like waterfront property. And I was like, wait a second, these are trailers. Like, this is a mobile home park. This isn't somebody's house, but somebody just bought a unit for 400 grand. And so I was confused about how it was set up. So what happened is the whole mobile home park, in essence, every unit owner, I don't exactly know how it started. I shouldn't say every unit, but a lot of the unit owners, in essence, put whatever they are, stilts or whatever, and then built up. And they each, in essence, spent hundreds of thousands of dollars to build a property. And then they still have their $1,000 a month pad lease to the mobile home park owner. But it went from like looking like a mobile home park to looking like a nice community waterfront with nice properties that were, painted in different colors that would represent Florida, your teals and your pinks and your yellows and oranges and stuff like that. So I was like, where is this? So it was interesting, but that was just a, different strategy. So like, I think they don't all look alike, even though I think a lot of them, everyone thinks, it's just trashy properties, and that's not the case. And it's like, oh yeah, here's a $10,000 trailer. Like, this is what it is. Like, that's not always the case. So your plan is, in essence, to buy these parks and not have any, park owned buildings.
Yeah, correct. And I think, the other thing too, to think about demographics, right? Because all of us that own rental real estate, whatever the specific asset is, your customer is the person renting. And there's a lot of people these days that are trying to downsize, right? Trying to spend less on housing, less on things to afford travel, to afford vacations, to afford other things. There's a shift in what people want. And it's not everybody. Some people still want their beautiful apartment in their space. There's always going to be people that always prefer to have their homes. But as individuals downsize, they start moving into a different cost of asset that they want to afford, right? And so when you get lower down, there's not enough homes in the lowest income brackets, because people that make more money who are downsizing are buying the ones that were really, from an income perspective or affordability perspective, were meant for people making much less money. And that's where our imbalance is in the world of affordability, right? And the need for homes that we have.
Got it.
I'm determined to try to help solve a problem, right? I mean, all of this is for profit. We're capitalists and things like that, but part of it is, how do you solve a problem that America's facing, and how do you do that for investors? And again, that you're placing yourself in a position to be prepared for what might be coming, or what I think is coming, right? And that's just my opinion. I might not be right.
Yeah. Just sitting here listening to the way like you speak about it, is like, well, how do you solve for a problem? Well, that's like, I think about like big business, and it's like, we're Apple. How do we solve to make sure everyone has a phone in their hand? It's interesting to hear your dialect by saying that versus me saying, well, all right, well, how do we make money with this thing? Like, it's interesting, and it's good, I guess, to have that mission behind it, to say, well, what are you solving for?
See, the people are the most important thing, right? And so when you go into lower income demographics, you have to be prepared to deal with the type of individual or customer that's going to be at your property, whether it's multifamily, whether it's mobile home, whatever it is. Most of those individuals have been excluded from things in their life, have been cut short by things, have a trust issue with people because people haven't trusted them, right? The apartment that property Litech one that I talked about, we bought it from a slumlord, right? I mean, the place was in disarray, pest infestations, mailboxes that had no doors on them, right? Even just these simple basic things that these individuals didn't have. It took us a lot to turn those around, but now you have individuals that care about their property. So I maybe take this a different approach. And I think there's a lot of people out there that care about the residents. And so it's not meant to say that people don't, but by focusing money and programs into giving these individuals more, and that doesn't always mean money, right? We try to partner with nonprofits that can bring in financial education, bring in other services, right? Daycare, after school programs and things like that. You help those people see value in your property and says, well, they care about me. I'm gonna do my best, right? I'm gonna change my life. And if you change those lives, the whole goal is to keep a tenant in your property, right? Nobody wants to unit turn every 6 months or every year, right? longer that person stays in, the less money you're spending. So I think you have to have that business plan mindset to do it, or go to a different asset class or go to a different plan. So it's not just, I'm going to get mobile homes and everything's going to be peachy, right? There's more to the story from that base of how do we approach these things.
So what do you think, kind of your kind of two-part question, and then we can kind of wrap this up a little bit. So what do you like inside the business the most, related to, operating, or buying these properties? I don't want to say, because it might not be operating, but it might be raising capital or something else. Like, what do you like inside this business the most? And like, where do you see yourself kind of down the road with, hey, my goal is to buy one of these projects a year, try to get it stabilized, move on to the next one. What are your thoughts on that?
I love the strategy piece. I'm big in the acquisition side of things, right? So I love looking at something and saying, what can I make this? What can I turn this into? What can I bring to the table? And how can we do it differently than maybe somebody else? And what can that outcome be? I mentioned the big into environmental. So, adding solar panels, people don't realize that, yeah, it's a big upfront cost, but then I control the power. I control the utility bills. Utility costs rise, which they do every year, and they're rising more and more. Guess what? My income keeps rising year over year over year. So I just look at things in a little bit different. So Jason, answer it. That's my beauty of it. I love creating the plan. I will be honest with you. I don't love being in the nitty gritty executing it. Asset management is not the place that I love to be, but it's important for me to make sure that it's set up properly for the long run. Where do I see myself? I'm just getting started, 2 years into ownership and stuff like that. 3 years from now, I want to own thousands of mobile home parks. I want to turn, my partner and I are launching a $20 million impact fund for these mobile home parks. Our goal in over 15 years is to turn that 20 million into, 300 million worth of assets. So I think the sky's the limit if you're just willing to put in the work.
Yeah, that is 100% the truth. And most people aren't willing to put in the work. And the fact that you can identify that acquisitions and capital raising is your strong suit and you need to solve for X, which is operations, it goes a long way. It's the same problem we had. We could do operations, but we always have to solve for X with capital. It's put me into some interesting situations, but we have friends that have the ability to raise capital, and it's there's a win-win there. It's just, what are you willing to give up? And too many people want it all up front rather than eating some shit to get to the other side. And I think you're right on the right path of doing it. It'll be fun to watch your growth, and definitely have to have you back on and see where your trajectory is over the next few years. One question we like to ask everyone is, what's one book or podcast that you've read or reading that you think everybody should know about?
Sure. There's a book called "It Takes What It Takes." And it's by Trevor Moward. I probably pronounced that wrong, but it's really about, we all have our things that trip us up. We all have our things that slow us down or do this. And I think each of us can complain about things not going the right way or not working. That book really put me into perspective, right? And it really is like, if you want something, you stop complaining and go figure out how to fix it, right? If you're just going to sit back and complain, well, probably should change what you want.
Yep, 100%. That's a good book. I haven't read that one. I'll have to stick that in the list. We'll get that to the show notes. Jon, where's the best place people can find you on the internet? They want to learn more about what you are doing over at Blue Eyed Capital. They want to follow your journey. Where can they find you to reach out to you?
Sure. My website, www.blueeyedcapital.com. And then I spend most of my time on LinkedIn. So Jon Weiskopf, you can find me on there. I post daily and always sharing what I'm doing, little nuggets of information that I can share. I have an impact newsletter that you can sign up on my website for. I'm here to educate and share, my 20 years of real estate experience and also trying to learn from others. So appreciate it.
Yeah, very cool. Guys, if you got any value out of this, the best compliment we can give Jon is sharing this. He just dropped bombs left and right. And we will catch you guys on the next one.
Thanks for tuning in to the Real Estate Reserve Podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.